we're going to unpack the real tension behind Robinhood's latest Q1 2026 financial numbers. If you follow the fintech space, you know Robinhood has been on this massive run, right? They're really trying to shake off those meme stock origins and become a true, mature financial powerhouse. But when we actually look under the hood of their latest earnings report, well, a much more complex picture starts to emerge. So today, we're sticking strictly to the data to see what's actually going on. Here's our roadmap for today. We'll kick things off with a Robinhood reality check, then look at the good and the bad from Q1 2026. After that, we'll break down their three-pillar business model, and finally, answer the big question, is Hood stock overvalued? All right, Section 1, the Robinhood reality check. So here's the central question we really need to answer. Does the underlying financial health of this company actually match the hype? I mean, Robinhood shares have seen an incredible surge lately, trading well over $80 a share with a market cap pushing past $73 billion. But here's the thing, when a stock is priced for absolute perfection, the underlying business literally needs to deliver flawless execution. Are they actually generating the cash and scaling the profits to sustain this? Or are investors just paying a massive premium for a good story? Moving right along to Section 2, Q1 2026, the good. Okay, let's start with the good news. Q1 revenue hit a massive $1.07 billion. That represents a really impressive 15% year-over-year growth. And you know, hitting over $1 billion in quarterly net revenue, that's a huge psychological and financial milestone. It clearly shows they're still expanding that top line, proving they've got serious reach and monetization power in the retail investing space. And this right here brilliantly illustrates the bull case. Look at that massive net deposit growth. It proves that assets are consistently flowing into the platform. In Q1 2026 alone, they pulled in $17.7 billion in net deposits. To put that into perspective, that translates to an annualized growth rate of 22% compared to their total platform assets at the end of 2025. What this tells us is that users aren't just, opening empty accounts. They're actually transferring real substantial wealth over to Robinhood. But it's not all sunshine. Let's look at Section 3, Q1 2026, the bad. So the absolutely crucial point here is that they are essentially buying growth by spending heavily. Yes, revenues grew 15%, but net income and earnings per share, or EPS, only grew by 3%. That is a massive disconnect. Think about it. When it costs you disproportionately more to generate your very next dollar of revenue, your margins get squeezed. They're basically running on a treadmill, running faster for sure, but not necessarily getting much further when it comes to the actual bottom line. Let's break down where the money is actually coming from. You can clearly see a staggering 47% drop in crypto revenue. Crypto used to be the absolute rocket fuel for Robinhood, right? But that engine is really sputtering right now. Now, to fill that $134 million gap, Robinhood has leaned heavily into equities, which were up 46%. But even more notably, look at that explosion in other transaction revenue. That shot up 320% to $147 million. So to replace that lost crypto momentum, Robinhood is pivoting hard into prediction markets. Now, sure, these look fantastic for growth on paper, but they carry some pretty significant regulatory and legal risks. That 320% jump we just talked about, that's primarily driven by event contracts, which essentially allow users to bet on specific outcomes. And the sources are highlighting that these products closely resemble sports betting and exist in a very, very gray jurisdictional area. In fact, several states are already raising questions about unlicensed gambling. So Robinhood is essentially swapping out one volatile asset class, crypto, for a highly scrutinized, legally complex product line just to keep that growth narrative alive. All right, Section 4, the three-pillar business model. So how do they balance out those risky transaction swings? Well, they've really matured from just relying on payment for order flow into this balanced three-pillar structure to stabilize their income. Pillar 1 is their traditional transaction revenue, so routing user orders to market makers. Pillar 2 is net interest income. By leaning into these high-interest environments, they're earning some great margins on uninvested user cash and margin lending. And finally, pillar 3 is subscriptions. Robinhood Gold is basically their crown jewel right now, charging $5 a month for premium yields, IRA matches, and access to their Gold Card. You can visually see right here how these 3 pillars combine to build up their average revenue per user, or ARPU, over the recent quarters. Notice how net interest revenues have become this massive, super stable foundation for them. It beautifully complements those much more volatile transaction revenues we talked about. And honestly, this kind of diversification is exactly what a maturing financial institution needs if it wants to weather market volatility. Which brings us to our final section, Section 5. Is Hood stock overvalued? Let's bring all this data together and do a hard reality check on their valuation. Look at these heavy financial metrics. A trailing and forward PE ratio near 40? That implies some incredibly sky-high expectations. It shows investors are paying a massive premium for Robinhood's future growth rather than its current assets. Plus, check out the PEG ratio, which measures price to earnings relative to growth. It's sitting at 2.58. Now, generally, value investors are looking for a PEG right around 1. So anything over 2 strongly suggests the stock's price is seriously outpacing its expected earnings growth. And when we contrast Robinhood directly against established competitors like Charles Schwab and Interactive Brokers, the premium they trade at becomes, well, staggeringly clear. Just look at the trailing 12-month price to tangible book ratio. Robinhood is sitting at a massive 13.54 times. Meanwhile, Charles Schwab is at 7.92, and Interactive Brokers is way down at just 1.52. Now, sure, Robinhood bulls will argue that this premium is totally justified by their rapid product innovation and a much younger, stickier user base. But make no mistake, you are absolutely paying top dollar for that innovation. In fact, if we look at an alpha spread discounted cash flow analysis, it estimates the stock is currently overvalued by about 43% compared to its base case intrinsic value. For those who don't know, a DCF model basically looks past the market hype and calculates the present value of a company's expected future cash flows. And according to this model, the base case intrinsic value for Robinhood is just $46.44. So with the stock trading way up in the $80 range, it really suggests the market has baked in a lot of absolute best case scenarios that Robinhood now has to flawlessly execute to justify. So we leave you with this final thought today. Is that premium truly justified by their fintech innovation, or is it just overvalued hype? Robinhood is undeniably gathering assets and growing their revenues, there's no doubt about that. But with stalling profit margins and a risky pivot into regulatory gray areas, that 40 times earnings multiple is looking awfully steep. As always, make sure you do your own research, really understand the metrics, and weigh the risks for yourself before making any investment decisions.